There's a theory, Etienne, and you'll love this. There's a theory, the winter of our discontent in the States. And it's always fascinated me, this theory. There's a reason why usually markets correct in America, usually around that September, October period.
Welcome back, everyone, to TM Sitting Down with James Whelan. We spoke a few times in the past. James is an investment manager based in Sydney, Australia. So how's it going, James, today?
Not bad. How are you now, Etienne?
Awesome. Good to talk to you. It's been a while. Today, I'm going to give you a view on kind of how to manage fund, how to trade fund, how to kind of look at different decisions in that case. And a few other things. Of course, we'll talk about options and a few more things. So I know we discussed maybe it's been 2 years or more. I'm not sure exactly how long. It's been crazy with COVID, but what's been going on since we last spoke a few years back?
Well, it's you're spot on about that. It has been crazy with COVID. It's been the only story that's really been going on the last 2 years, and everything that's just been based off the back of that has dominated the headlines. Every single thing that you can see is going on now has had something to do with the COVID situation. Even now, you can draw a long line to what's going on in Russia with Ukraine also being linked to this COVID situation. Now, I think we last talked it was 2019. It would have been so just before all of this happened. We were in our Darlinghurst offices. Remember, and you talked to us about some of the bits and pieces that are in that. Even us VFS here. I mean, we've moved from our Darlinghurst office where we had a really nice big space, and we realised after a few months of COVID and everyone working from home that we didn't make that massive space anymore. So we purchased our own little office here over on the north side of Sydney in Milsons Point, and we've got our own little digs here that's in a much smaller area. And a lot of companies making those same decisions, and a lot of funds are actually now being run where half of your team aren't actually on site, aren't actually on deck anymore. And that's something that I wouldn't mind going into a little bit about, that of how to actually run a modern day fund manager, retail advisory area with when you're only really face to face the rest of your team maybe once, maybe twice tops a week, and just what the challenges that added to this company and how we managed to overcome them. If you want to talk about that, make a note that I want to talk about that later on. Okay, if we run out of things to talk about, but yeah, that's where we've been. So look, it's gone full hell for leather into COVID. It's changed the way that we do things. It's changed the way that the market works. Definitely communication levels have changed. Everyone suddenly realized that they had to download Microsoft Teams, even though we wanted to avoid doing it for a long time. We got forced into it as if Microsoft were actually the ones behind COVID suggestion, just to make sure that everyone actually has to download the damn Microsoft Teams that nobody could tolerate. But here we are. So that's how it's been going, man.
Interesting. And I think it's a big difference with COVID. People are getting used to working more online, and you don't have to go in person anymore for working, pretty much. That's good news. I'm curious to hear more about that for sure. So tell me, what is your role as an investment manager? Like, what do you focus on? What do you do? And is it just like the trading part, or is it more the client relations part, or what does that involve exactly?
It's a bit of an everything hybrid job. I've sort of built the job around the way that I work best, which is something that I would advise a lot of people to do if they have the freedom and the flexibility to do it that way, because I'm someone who's not easily distracted, but I like a lot of different things that sort of go through my day, a lot of different opportunities that's there. Client acquisition, yes. Client maintenance and relationship, yes. Staying across what's going on in the markets, obviously that's pretty important, but also being able to formulate ideas and themes, and then also being able to find the actual structures and products that people should be able to go into, and also doing the bits and pieces of the media, which keeps my mind focused on exactly what it is that we're supposed to be talking about and what it is that is going on in the market, and just writing and general doing that. Also doing all of the trading that needs to go on in that space too, and updating portfolios based on client needs. Overweight, underweight certain areas that need to be done, whilst also maintaining the portfolio, because our portfolios are tailored to individual clients based on their risk profile and also their goals too. So it's all of those sort of bits and pieces that's thrown into there at once. And I know that it was one of a very small piece of the puzzle that was in there, was actually staying across what's going on in markets. Sometimes you get so focused on what's going on in this one, you completely miss someone. And next thing you know, Russia's got tanks lined up on the Ukrainian border, and you missed it for a day. But you got to try and catch up on that. And having to go from being a pandemic, an immunologist, a virologist, to being a world affairs and current events a geopolitical expert at the same time, and also being able to talk to it at a certain level of expertise to clients in the media. That's sort of the day-to-day job that you've actually got, along with actually trying to people into things that are probably going to go up than down, and not blowing up anyone's capital on the way through. That's sort of the job. That's what I do as an investment manager here, and it's a pretty cool job.
Yeah, so lessons involved there for sure. That's pretty cool. So how do you decide what to trade or what to focus on in terms of your investments? Is it already given to you with technology? Like you have scanners that run telling you what to focus on, or do you have to kind of look at the market and decide yourself?
In the last few years, we've sort of made it a little bit more bringing into it, just to have a bit more regulated, like a quant that sort of makes some good suggestions about some things that we should be in, some themes and some stocks that we should be in as well. And we've developed and tailored those using our own, our own IP, and also some various sort of things that we know in the market, and how to just utilizing our expertise in that, but also to have a quant that just comes, for example, what is it? It's probably about a year and a half ago, sort of as the pandemic was going and the NASDAQ was absolutely ripping higher. We developed a strategy to pick out the best 5 stocks in the NASDAQ, and based on a whole bunch of technical areas, and just sort of keeps you invested in that, and we'll pull you out of the market if it all sorts to go badly. We decided that was worth having 10% of portfolios dedicated to that. So 2% holdings in each one of these stocks on the NASDAQ as they get called out. We've also got some ETF thematics that's in there as well, and just tweaking the way that works too, so that we've actually got more holdings in certain themes and certain ETFs, and so it stays invested. We're just changing the weight. So we've got quants that are around that. Overarching all of that, so myself, I actually run what's called a global macro fund. It's, again, tailored to individuals. So it's not, not the perfect example of a managed fund, but it's sort of more just in that it is a general a general asset allocation that we have based on risk profiles, and that's sort of how we have people being into there, and then individuals get tailored after that. My job is to take the thematic big picture demographic shifts and go, okay, right now we've got so take, for example, food, where in April 2020, with pandemic going in the direction that it was, I saw food as being a great investment piece, and found an ETF that hit that and hit that quite well and quite hard, and went long food companies through an ETF. Commodities, same sort of thing. It's picking those sort of areas. And that's really sort of what I do, is that I go through and I flick through, and most of the time you don't do anything, but most of the time what you want to say is, okay, I can see that there is a big demographic shift, or I can see that there is a huge weight of money going to a certain area. Now I'm going to put my clients into that and have that big block that's going in there. So yeah, I build that portfolio based on that, keeping it within the risk parameters that we have for clients as well. So things like food, things like Google, commodities I mentioned. Right now, big play for mine is going into value and adding to value. I've been long value for about the last 8 months or so, and that's going quite well for us there too. And quality as well. So it's taking those sort of bits and pieces and saying, okay, so and then I've got this idea of going into quality. Okay, so what are the best quality ETFs that are in line with what clients need? That's sort of my job, and that's how I construct it. We decide that, okay, X amount of allocation for high risk clients is appropriate for client needs. X amount of allocation for balanced clients is exactly what's needed there too. Making sure that it's all in line, as I said. So that's sort of the creation that I do. It's just picking the big themes based on the research and the evidence, and reading and knowing what's going on, and going, okay, this is how best to access this particular theme or this particular trade. Sometimes long, sometimes short, more often long than not. But and that's sort of what I do. Is okay, so here is the right product for the clients, and now this is how much we need to put in for the clients, and then you execute that trade after that and make sure that it's all in line.
Is there also a lot of like manual trading involved in terms of timing when you get into ETF, or do you just get in when you want to get in and that's it?
Yeah, my timing is, I hand to God, my timing is always the worst timing in the market. It's something that I'm always trying to improve in myself. If I write my little criticisms and reviews of myself, just every new year when you do it, it's just like, be better at timing the market. So, but for the most part, I like to just have an idea. Here's a theme. Don't muck around with it too much. I can see that on a technical area, or I can see that on a weight of money area. It's not really going to matter that much, just getting the ins and outs of exactly where it is. If it's looking at something that might be, say, a bond ETF, where it actually does matter where the yield actually is on that, or if you are playing in that sort of space where you actually need to get the yield right, then yeah, okay, you've got to wait for your entry levels to come in there. But for the most part, if you have an idea, if the market doesn't look crazily overvalued, or if it doesn't look like, when you see a theme and you see that the line is going from the top left of the chart down to the bottom right of the chart, you've got to start to think, well, maybe I'm not quite right on the theme. It's something that probably since I last talked to you, I've been better at improving of going, just because I think that that is the case, I need to actually pay attention to the weight of money, because if I think that something is right and I think that something is a theme, you could be right, but that next step, it doesn't matter being right. You have to actually see a reaction in that market and see a reaction in that trade. People can be right about things, but then not actually have the right way of going about it. You could be right till the cows come home on a food trade, but if food companies aren't actually getting bought and aren't actually going from the bottom left to the top right of the chart, then it doesn't really matter what's going on in this space. And that's sort of now that next decision, and finding myself, being more aware of that. It's okay. You can be right, but it doesn't matter if you're right. You've got to actually have the right product that's actually going to move to it. And that's sort of that next level of investigation that I do, that I wasn't really doing as much as I was a few years ago. And now I'm really sort of aware of it. And it's definitely made me a lot better. Every day is a new day. And it doesn't matter how long you do this game for, there's always more to learn. So that's sort of where that's coming.
And how, or when you know that when you're not right with your trade, do you know like right away, or is it something you have to wait for a level to get to, price get to a level, or how do you know when you have to get up?
I've sort of got two different things about getting out and getting in. I will go into something. If it's more of a satellite trade, where I think, what's an example? An example would be, say, China tech stocks. You can go into that and say, I think that China tech is undervalued here, and we can see some great value that's on that. And then if you see that you're actually wrong, and that it's actually not being bought, and that there was no momentum behind it, there was no one else who agreed with you on that particular trade that came in there, then you need to set a stop. And if it does go through there, then that's it. You're out, and you don't need to know about it anymore. Reinvestigate it and just say, you know what, we'll roll this time, but we're going to probably have another crack at it. And then there's other ones where it's a straight conviction. I don't care where that chart goes. I know for a fact, or as close to a fact as I could possibly get, I know in my absolute heart of heart and guts and on the paper and everything I need to know about, that I can ride out a huge drawdown on particular stocks or particular ETFs, because I'm happy to be a conviction play on this one. Like I said, my timing is not always right. And like I said too, being sort of a smaller shop, a boutique shop, it means that we're not right on the coalface with all of the weight of money of some of the big houses. So we don't know what Goldman Sachs is really going to do. We don't know what JP Morgan is really going to do when they're moving their money. We don't know what, say, BlackRock is actually going to be moving into or deciding to add into certain portfolios, little bits and pieces like that. You're not always on the coalface of that particular area. So that's why you sort of got to watch to make sure that it is. You're either right or you're either wrong. One of those trades was Google, and also actually recently BHP. I was wrong on BHP for months when I bought it last year, and I went in as a conviction play. Great dividend, great company. I saw copper price going up. China wasn't buying as much iron ore, but I knew that their iron ore buying is going to come in probably in the next few days after the Winter Olympics is closed, and they can start to get those factories turned back on. And BHP was down about 20% or so. And there was a lot of people who said, well, you got your BHP trade wrong. All you got was a dividend in there, and now it's absolutely ticked back up, and it's well and truly up, and it looks to be back on, heading back towards its all-time highs eventually. That's something that I had no problem holding BHP through thick and thin. Something like maybe Alibaba, I don't think I'd want to, at some stage I had to just say, I can't hold this stock in this weighting anymore, and I need to cut some out here because I am wrong on this thing. And there's only one thing. If you're actually wrong on it, there's only one thing worse than being wrong, and that's staying wrong. So that's sort of that one. So you can sort of be wrong. Yes, I am wrong on this one, but on BHP, no, I'm not. That's that expertise. It's sort of difficult to quantify.
Yeah, that profit problem is a big problem though, because like let's say you hold a stock goes really well, or even an ETF that performs really well. How do you decide when you want to get out of it? Because it could give you like really good gains, but then at some point you got to get out or reduce.
I do this little thing that I've introduced over the last few years as well, of having a profitable stop, or definitely a reduction is in order. Once a quarter, we have a look at our weightings and say, okay, I can't have a 6% allocation in a single stock. But for example, Google went to a level where it was just like, this is now too big an allocation on this one. I'm up a couple of 100% on it. Zscaler, same thing I bought in there. That was another one where all of a sudden you're up 300% on this thing, and all of a sudden your allocation to it goes from being 2 or 3% to suddenly being quite substantial. We need to cut this back. And that's sort of what you do every quarter, and you reweight and you bring things down, especially those profitable positions. Just come back a little bit. Don't get rid of them completely. And then you've got this other sort of situation where and I do this with clients and on my accounts as much as I can for certain things that I'm happy to get rid of. You think that the theme might have come out of, take, for example, Zscaler. where maybe some of the juices come out of those tech, cloud protection, data provision software stocks. The Zscaler was one of my original horsemen of the apocalypse that I created back in March 2020, where I said that it was Netflix, Zoom, ResMed, Zscaler, Google was in there as well. It was just sort of, it was the work from home stocks. It was what you need. The apocalypse is here upon us, and food was a part of that as well. Something like Zscaler. So, for example, when you see that the juice is starting to come out of that space, and maybe some of the rotation of money away from that trade is moving away, and you're going, okay, I'm going to be wrong on this one soon because the weight of money isn't supporting my idea anymore. Then you set what's called a profitable stop. And on a single stock, it's really easy. You pick a good, healthy technical level that's on a certain chart over a year or maybe a 2-year sort of period that you're looking at, and you say, if it drops through here, I'm actually now that's the point. That's the line at which I'm happy to not know about this stock for a while now. And I've done that. I've done that with a lot of things as this market's gone up, and then you have the jitters similar to what we're having now. We had one last year. Sort of go through these ones, and I set these lines that are down below these key levels. And they very rarely do they get hit. It's something that's quite interesting. I'm an okay stop setter. There's a credit to myself there. I'll give myself a little pat on the back. But yeah, you set that line and it's a profitable stop. And clients are happy with that because no matter what, it does go through that point and you can still lock in a profit, have some cash waiting for the next one. But you only do that with stuff that you're okay. The only time to do that is when you think that, okay, yeah, the theme or the juice is sort of coming out of it, that the weight of money is moving away from that sort of area. Similar now, I do it with growth stocks. I do it with stuff that's in the growth portfolio. I don't think I'd want to be doing it with the value side that's in my portfolio either. Right now, the value is definitely getting the weight of money, and so I wouldn't want to be stopped out of any of that stuff. But if the growth stuff, I'm happy to put stops under there and see them go away. And that's do you sort of see how I'm coming up with that idea that if you see the weight of money moving away from it, then I'm happy to take a profitable stop. But if there's still money weight going into my holdings, then I don't want to set a profitable stop there.
Interesting. Has VFS gone into cryptos at all, or is it something that you don't consider yet?
No. Yeah, we do. We sort of want to. I'm a pick and shovel sort of guy, in that I'd rather own the company that sells picks and shovels to the gold mine as opposed to owning the gold mine. I'd rather own the company that is doing stuff with crypto, doing the exchange. Made the mistake. Happy to put our hands up. We went into Coin. Was it CoinSpot? No, who was the provider? The big one. It's left my head now for a second. The exchange, the online broker. They listed last year or whatever they did. We went into that thinking that'd be a good. It was just way overvalued and came down, and that was one that we just cut. You have an idea, get rid of it, and that's it. What we're seeing now is a lot of ETFs coming up, and I'd rather really own an ETF in a crypto area. So there's some stuff that's coming out in Europe. It's got to be the spot ETF. It can't be the future, because the futures ETFs, you get the money sucked out of it just on rolls, and it's all very confusing. Stay away from futures ETFs. But as we're seeing the SEC still hesitating to approve a crypto spot ETF, once the SEC does do that, I will have more conviction that I'm okay to allocate a small amount of client money to it. I say that very hesitantly because I want to make sure that the client actually does it, because we work on a discretionary basis for most of our clients, where they give us a certain mandate that they're happy for us to work within, that has been agreed with us, and it's all signed off, and it's all very, very heavily regulated without working on a discretionary basis for a client. Something like crypto, I don't think that a client would. There's some people who would probably not look. 1 month they look at their portfolio holdings, or one day they go in and look at their holdings, and there's a crypto ETF that's in there. I think that I'd want to know the client actually was really cool with that being on their portfolio before I went and did it. But the key trigger for me is going to be the SEC approving a spot crypto ETF. When that happens, the weight of money that's going to go into those ETFs, and therefore into all of the background and into the actual physical crypto or into those coins, is going to be pretty significant as that weight goes in, because there is a lot of money on the sidelines that's been waiting to go into crypto, but it's just got to be something that's set and regulated and definitely trading in the biggest market in the world. I noticed that Fidelity just launched an ETF, I think it was last night our time, in Europe, that's charging 75 basis points. So it's like one of the biggest ETF providers doing a relatively cheap ETF in spot crypto. I think it's a spot Bitcoin ETF. That's the sort of thing that I'd like to see in America. I might even be happy to look at that one as well. But in answer to your question, yes, I am looking very closely at it. And I think that the amount that you want to have for a balanced client, probably not for a low risk client, but definitely for a balanced client, you might want to have a look at maybe about 4 or 5% to start off with in some crypto. Is it a store of value? Probably not, but I do think that Bitcoin is probably likely to go up more than it is to go down. Not that I'm one of those crypto bulls or anything that's there. I stress that pretty heavily. But yeah, I think that Bitcoin has probably got more upside than downside from here.
Interesting. So what makes you think that Bitcoin could go higher, given that we have like these big moves so far? And
yeah, I don't think we're going to see Bitcoin below. He says it now. I don't think we're going to see Bitcoin below $40,000 again. And that's a big call. But the idea is that I think that just the entire way that it's structured is that Bitcoin is eventually just going to keep tricking up higher. I think that's just the rule. That's just the rule of how it was built and created, wasn't it? That Bitcoin was that way. People are starting to see that. And what is refreshing for Bitcoin, and that's going to get more people involved in it and probably push it higher. I don't know. Where's the number? 100,000, 200,000 for Bitcoin. I know that used to be a time when it was like, oh my goodness, he's out there making headlines. If you told me that Bitcoin was at 250,000 in a few years, I probably wouldn't flinch at all. It's perfectly understandable. If you could say it out loud and it doesn't sound ridiculous, then it's probably something that you can have as a plausible investment thesis for it. But as people are now realizing more and more that just how trackable Bitcoin is as a crypto, it's as if cryptocurrencies were created by the exact regulators that people don't want the regulators to regulate, if you know what I mean. It sort of finding a way to put this sort of very subtly that, it's as if the CIA created Bitcoin. You can see how easily traceable it is. You can see one point to another point where it goes in and out of wallets, and you can see sort of heat maps of exactly where it gets traded. And people thought that it was the libertarian ideal of being able to have cash that the government didn't know about. It's actually easier than ever for the government to specifically know exactly how much you've got and how much you're transferring and where you're transferring it to, more or less. And I'm sure I'll get critiqued for that opinion. But and now it's led to what's going on in China, where they have a set constructed currency that is then able to be controlled more easily for the government. It's something that was created that it's sort of doing the opposite of exactly what it was created to do, these crypto coins. And it's actually bringing people more under the control of when to do it. Fascinating thing with the Chinese, I'm following the Chinese crypto. I was following it fairly closely, but it's fascinating. They can actually create time limits on the coins that they give to people that people have earned. So if you want to get money into the system and spending, if you want to create that spending flow that everyone's always lacked being able to do, how do you get people to spend more, to try and get inflation up if you want it to be up, or spend less? And they can set time limits on the coins that they have in China. So you have to spend it by X, otherwise it's going to be disappeared and your money will be worthless. And so that's a great way of sort of structuring an economy and controlling an economy, very much in line with the way that China has been running things. But I think that it's only a matter of time until eventually other governments in the world and other central banks in the world do see that as being a potential advantage of crypto coins and start to bring it into their adoption practices as well.
Yeah, we'll see how that play out. Definitely interesting to think about. Pretty cool. So what would be your advice for someone who is looking to manage capital? They want to either start a fund eventually, they want to be able to get clients. What do they have to kind of provide and show the clients to get their funds and invest them?
Oh, the pain and the expense of starting your own fund now is definitely not something that I would advise anyone to do. You need the regulatory hoops that you need to jump through are pretty significant. So it's definitely not something that I'd recommend anyone really kick off with. If you're going to be doing anything that you wanted to do, I'd sort of go in and, as an advisor, make sure that you're accredited. It's not that difficult to be accredited, but get a start somewhere and work through in that particular way. Starting a fund is not an amazing way of going about it. There are ways to do a thing. Just a second. There are ways to get it a fund done through, you could say, an unregistered managed investment scheme. It's not really something that I'd recommend anyone really just have a go at in that space. Really firmly just going to suggest that people don't crack into that practice.
But you could join a fund, join in his fund and try to, yeah. So what would that take for someone to be able to join a fund and trade for that fund?
What people want to see, obviously starting as a junior or starting as a fund, what people want to see is sort of using your own, that you've used your own interest and you've got a real fascination with spreadsheets, just putting it cynically, but not really that cynically at all. If you've got a real fascination, we've seen kids and guys and young people who have shown that they're interested in the life and the space, but not really that fascinated on going themselves, if you know what I mean. Like, you can build your own API and have your own code and say, I've got this structure that I've been able to create, that I could see that, you know, I've built this code. It's got my trading triggers. It's in here, and it's just that sort of interest and fascination. Whilst it may not be something that the fund uses, it's the sort of thing that you'd like to see, that someone's actually got a real in-depth knowledge of what's going on and what drives the market, what drives the numbers in the market. On top of that, I would want to see someone who actually really has a good, strong understanding of exactly what moves money and what moves markets, and the underlying inherent nature. You don't have to know every single thing about every single stock, but you definitely have to know what moves things and what drives things and what changes. Why did gold used to go up and down when gold used to go up and down? Why does the yen get bought at certain times? What drives the US dollar? Those sorts of things. When is Europe a good buy and when is Europe not a good buy? Those sorts of just big picture and big ideas, and then being able to drill down, finding certain longs and certain shorts, and having your own. That's the sort of thing that I'd be interested in seeing if someone was going to have a go at joining a fund.
Interesting. So understand the bigger picture, not just a chart, not just a trading aspect, but the bigger picture of things, basically.
Spot on. I want someone who's across the whole thing. Also, you know what we're finding is that in this industry, remember a few years ago when everyone said that robo advice was coming, everything is going to be robo advisors. Us old dinosaurs won't be a thing that is around anymore. Well, we're still here. Lots of advisors are still here. In fact, it wasn't robo advice that has chased all of the advisors out of the industry. It was, in fact, the regulatory necessity for everyone to pass the FASEA test, which is a huge ethical and compliance test that we all had to do after the Royal Commission that they made us do. It wasn't really that difficult, but a lot of study, but the sort of stuff that advisors really should have known anyway for a retail level, because I do talk to retail clients, so I need to be across that. And the FASEA exam was actually the reason why thousands of advisors left the industry last year. It actually wasn't robo advice that chased the old advisors out. It was just having to do an exam. Fascinating thing that was there. So it seems like all the chat about robo advice is now left. What it's been replaced with is individuals, and I love this, individuals doing their own thing via their own trading apps and actually having more control over how their markets, like how their portfolio looks, how their super fund looks, and having that sort of interest in what's going on in the market. Robinhood, as much as I don't really like Robinhood, and I never really have liked Robinhood, but Robinhood definitely opened up the door to a lot of people who took control of their own finances and their own portfolio. And that's the sort of thing that was really fascinating. Robo advice now isn't really talked about anymore. So you've got us that's here because people actually want to talk to someone, a real human being, about what's going on in their investments. And then you've also got the people who are just taking charge of it themselves and having a real interest in it. Unfortunately, the fodder in that situation is what's going on, say, with the meme stocks, of people being massively leveraged going into things that absolutely that the juice had run out of them in a manipulated market. So that's that. Unfortunately, there was a few exercises there, and a few people sort of fell by the wayside in that tragedy. But the net result of that is that people now the rise of those apps means that people have got more control in their portfolios. It's a wonderful thing to see.
Awesome. Yeah, definitely. Now, I'm sure that happened to you before. That's the question I got before to ask you. So someone was asking, when you have a tough period, you have many losing trades or many like wrong decisions. How do you stay top notch? How do you keep on track with the trading and managing the account when you have a couple of either drawn on like a bad timing or whichever?
I did. I had a clanger in gold that actually came out. And clanger is a loose way of saying it. I had a gold position that I left a little bit longer than I should have. I was absolutely wrong on it, and it really did hit me. That was in February last year. My performance was actually, if you take that one clanger, it was actually a committed decision that I made. So it wasn't an error, but it was an actual decision that I made. I'm happy to put my hand up and say there was a few percent that was taken out of my portfolios because of that, and that was a decision that I made. And I really had to reassess exactly what I was doing, what decisions I was making, and a bit of a gut check. Because otherwise I would have been up by quite a significant amount for the year. But then you have that thing to sort of eat away at portfolios. That sort of rides with you. It takes a while for you to catch that up. And then, okay, so you step away. What was my decision making on that? What's wrong with me or what was right with me? what was wrong with the market or what was right with the market. Market's always right. Market's never wrong. I'm the one who was wrong in this one, and I tried to take it on. And I think that I let my ego get a little bit out of hand that I was there. Maybe needed to focus a little bit more on exactly what I was supposed to be doing, and I found that I was maybe too diverse across too many different things, not really knuckling down and focused on exactly what the drivers were behind that gold position that I had. And I also, this is going to sound pretty big and probably not the sort of thing that you'll ever hear someone like me, an investment manager, say, but I had to actually put my hand up and say, I am wrong about this, and I actually have a problem, and I'm going to have a bit of a look at what it was that was the cause of that trade. And I actually did. It was a self-analysis. The first step was just, unfortunately, it's going to sound weird. The first step was just admitting that there was actually a problem that was there. And that was sort of a little bit of assessment, a little bit of time away from the screens just to make sure that I wasn't. Played a little bit of golf, and then I got back into it. Portfolios will usually manage themselves okay if you don't look at them too much and you don't have stupid risk positions. It was a position that was a bit too big for the portfolio, and it ended up sort of going wrong. And it was just a simple basis of my own ego and my own attitude that was on portfolios. I'd had a really good January, which meant that I was okay taking a bit more risk in February. That doesn't make any sense, because you shouldn't ever take any more risk just because you've done well the month before. The position should just be the position that you have. I'm thinking, I'm taking crazy pills here. Why am I doing this with client portfolios? I can think that a position is right or a position is wrong. And so that was sort of part of the assessment that I did of exactly what I was going on with my trading. And it's made me a better person, as we all should be. What's your critique? What was wrong with my position sizing? I had a position that was theoretically too big for the accounts, that if I was wrong for a little while and it actually ate quite a few percent out of the portfolio. And I'm happy to put my hand up and say, you do get these things wrong. Like I said, being wrong is human. Staying wrong is the real problem. And that's when I put my hand up on that one. How do I get over it? Sunshine. Cut down on drinking. Go and play some golf. Talk to people who are outside of the industry. That sort of thing of just stepping away from it. Spend some more time with your kids. Spend some more time with the dog. That sort of that sort of. It sounds like it's a motivational poster that I'm probably going to see back up here. It actually does work. You need to step away from these screens. You need to not be reading the same research every day and just go away. And that way, when you can come back, oh, look at this new thing has changed. I've got this new outlook. I've got this new, refreshed opinion. You find yourself so buried in it and so bogged down in it. The next thing you know, it's all that's driving you in there. There is a theory, Etienne, and you'll love this. There's a theory, the winter of our discontent in the States. And it's always fascinated me, this theory. There's a reason why usually markets correct in America, usually around that September, October period. They've just had, because the Americans work their asses off, right? And we know that this is the case, that they work a lot of hours, they take very little holidays, they keep on going through, and they have that beautiful break, that summer holidays when they do, and they get some time away. And that's the time to, some real time with their families and everything they want. Your standard Wall Street guy does get some time off, and it's fantastic. And then September, October is about that time that they start to come in, and the mentality changes a little bit, where the weather is changing. You can see that sort of the sun sets earlier, rises later. And what have you got ahead of you? You've got summer holidays at miles away. You've got to keep on working through here. You've got Thanksgiving ahead, which is always a very, very stressful time for people, with families, and you have to travel. Travel time is awful. And then behind that, you've got Christmas also, which also starts to drag you down too. So the days are darker. You see less light at the end of the tunnel. And that's why, and in those times, the theory goes that in September, October, when the market, as it inevitably does, starts to come off a little bit, you just say, you know what, screw it. I'm not going to hold this market up. We're not going to be buying this market. I'm happy to let it go, because your mentality changes. You become a little bit more negative. That's the theory of the winter of our discontent over in the States. And I think that there's a lot to be said for that. If you find yourself, you're sitting in a dark room for 12 hours a day, looking at the same line tick up and down on a certain block, you're probably not going to be the best possible decision maker you can be. Go and get some sunshine, change your pants, put a shirt on for God's sake, and go and play some golf and get some sun, and talk to some old guys about their gold positions. Talk to some old guys about their boats, about things that are there. Change your perspective. Have some ideas from outside that. That's how I managed to get through it. It was a real big. It was a hell of a year last year. Also, it wasn't made any easier by the fact that we were locked down for most of the year either. That definitely changed our outlook.
Interesting. That's a really cool theory. I'll have to check it up after for sure. Have a look at that. Yeah. That's interesting. So I want to respect your time. This was really good advice, I think, for people. I want to respect your time. And where can people find you if they connect with you or reach out after the interview?
Yeah, I'm on J. Whelan, Whelan, at vfsgroup.com.au. Send me an email. I got no problem with that. If you want to make it easy, it's GMF, Global Macro Fund. So G, Golf, Mike, Foxtrot, at vfsgroup.com.au. We've got a beautiful website that's there. I've also got my own website called Whelan Capital. Just type in Whelan Capital. There's ways to reach me on that way too. That website's just a way of just having videos and funny things. And I will definitely put this one on that website too. So if you want to have a look at that, then do it. Set up a meeting. I'm happy to help anyone. Any young people, I've never, ever turned down an honest request from anyone for any advice that they want about their career or trading or anything that they're trying to get better. All I want to do in this industry, and I said this when the day that I joined all those years ago, 15, 16, 17 years ago, whenever I joined this industry, was I just want to leave this industry in a better place than where I found it. Every day I try and do that, and that's what I try and get out of it. So if you want to reach out and have a chat about anything, I'm more than happy to help. I'll never turn down an honest request.
Awesome. I really appreciate it. And I'll put a link below the video for sure. People check it out and contact you there. So I appreciate that. Thank you, James. This is awesome. And I hope we can catch up soon in the future.
Yeah, mate. I look forward to getting a beer in with you very soon, mate. Have a good one. Talk to you later.